I think averaging for this year would be about $50. And that is because we have OPEC. If there was no OPEC, the price would be $20. So OPEC has done a lot in keeping the prices up, but $50, $55 would be reasonable. These current prices are too high. If they go up too fast for no reason, then they have to come down again.
So Fashiraki's message there is that if OPEC hadn't stepped in to stabilise the market and limit supply, then oil prices could have been even more depressed, possibly well below $50 a barrel. Maura, back to you now.
Well, let's bring in Jonathan Kornfeld. He's the Director of Asia at Hudson Capital Energy and joins us here on set. Jonathan, we're getting close to $72 a barrel here. Last time we spoke, there's still concern about whether there's enough demand out there to justify $72 a barrel.
Right.
Has that scenario changed?
No, it hasn't. There certainly isn't the demand to justify $72. What we saw yesterday, the market gained some fresh legs off the EIA numbers, showed a decent draw in the crude inventory numbers. And what that had a lot to do with was the gasoline demand is slowly starting to tick up. It's still somewhat anemic, but it's ticking up. So the refiners are actually pulling through some of the crude that's stored and turning it into gasoline at a profit. But there's still an enormous amount of crude oil. There's an enormous amount of products sitting out there too. So what we've seen is really funds pushing this market higher, and as it continues to get fresh legs, you see more funds and more money pushing it higher.
No one wants to lose out.
Right, no one wants to lose out.
Jonathan, I can't help but thinking that the market is really running away here and is way ahead of itself, especially when you look at it in context. You take the global inventories and the US inventories into context, and you say that they are almost 20% above the year-ago levels. I mean, surely that must tell you that there's quite a sizable overhang.
Absolutely, and look at days supply forward in the low 60s now. Typically anything above 56 or 57 days supply forward is considered very bearish, and we're into the low 60s right now. So basically it's just as Maura said, that nobody wants to miss out right now, and the rally started in the low 50s, and as it continues to get higher, it just gets more and more momentum. We happen to be sitting right now right around some technical resistance, around $71.85, $72, which is where we are right now. So it'll be very curious to see what happens the rest of the day in Asia and what happens in New York, whether we can break through this, continue to settle higher. But the more we rally without any sort of pullback, then the bigger the fall is going to be when it eventually does correct.
Jonathan, what would you say is the short to medium term outlook for inventories, especially in the US and further afield? Because a big theme in the market, because of the structure of the futures market, has been the contango. A lot of oil has been placed into floating storage. Now hearing that some of that oil is finding its way out of storage back into the inventories, is that going to become a bearish theme?
Well, it is certainly starting to find its way out of the offshore tankers coming back onto the market right now. In terms of gasoline demand, the seasonal demand period is actually already passed. We passed Memorial Day in the United States. The gas crack, the margin is still very strong, so you're still going to see, as long as that margin stays strong, the refiners are going to continue to pull on crude oil inventories and turn it into gasoline. But until you actually see the demand get off the anemic number that it is in terms of gasoline, a little over 9 million barrels a day, then there's really no cause for the price to be where it is right now, and it will eventually trip back down. And I think we could certainly go back into the low 50s, not too far from now.
To what extent, then, can OPEC participate in moderating expectations for crude prices? I mean, we've seen them trying to come in and support them, but do they have any advantage right now or any benefit coming in and saying, whoa, you guys, let's not get ahead of ourselves and go to $80 a barrel?
Sure. I think OPEC is interesting, actually, and they usually sort of rail on speculators when the market sort of rallies without any sort of demand. But some comments we heard yesterday from Iranian Governor Katabi, Mohammad Ali Katibi, said that as long as the price continues to rise and if the day's supply forward drops, then they will consider increasing production, and that would drive the price off. However, for days supply forward to drop, that would mean that there's more demand coming on and buying this more expensive crude. But at the moment, it's not demand that's pushing the price higher. It's funds, it's investment flows that are pushing the crude higher. So we may end up seeing higher crude, lower demand, and more days supply forward, which is inverse to basic economics.
And of course, at the same time, I understand Saudi Arabia is also ramping up some production of oil as well. Really quickly then, is that going to play a factor into it, or is it really just still financial market factor?
It's the financial market factor. The Saudi oil is mostly the sour crude, and there's not huge demand for that. It's really the light sweet crude that people want.
Okay, Jonathan, thanks so much for joining us today. Appreciate it. Jonathan Kornfeld here, Asia Director at Hudson Capital Energy, joining us. Coming up next on the market, or on cash flow, I should say, the markets in Indonesia are opening up. The Jakarta Composite Index kicks off trade in 3 minutes' time. We'll have the opening numbers for you next, right here on Cash Flow.